think right now the problem is not maybe as people had anticipated, late last year, we'd be in recession right now. It's actually that the economy is still holding up a little too well, particularly the labor market and inflation data. I think the risks right now are that the Fed will be kind of pushed into raising rates even further than they already have, and kind of over tighten, kind of overstep, as far what they should be doing on interest rates, and that will then later, 6 to 12 months later, cause more of a slowdown than would be otherwise maybe necessary. But I think the economy still has a decent amount of kind of momentum coming into the year. Certainly the January data looked like that. And I think we will start to slow, but I don't think we're in any danger of an imminent recession. I think it'll be more of either a late 23 or 24 topic before we really get there. I think the concern now is that interest rates and monetary tightening are going to become go overboard and get too aggressive. I think that's the risk that the equity markets are pricing right now. I don't consider a low unemployment rate itself a problem. I think that the Fed is certainly looking at it as a concern if they consider the labor market too tight, which is going to put upward pressure on wages. But yeah, you're right. The unemployment rate did tick up into the report just released this morning, and the average hourly earnings growth is also reported in that data slowed and has shown less signs of wage pressure in addition to slightly fewer hours worked. So I think there are some initial signs that the labor market is starting to become a little less tight. And we saw the initial weekly jobless claims yesterday show an uptick, meaning there's been a slight increase in the number of people collecting unemployment insurance. So at the margin, there are signs already that the labor market might be getting a little less tight. So I think the question for the Fed is really how far does that have to go before they will consider the inflation pressure from the labor market to be moderate enough to stop raising rates. But it does tell you that the economy is still relatively strong, that there is still income growth to support spending, and that there isn't probably an imminent risk of recession. That usually it takes a little while longer for these things to play out and for the momentum to slow down enough to drive a recession. So I don't think it's, like I said, I don't think the killer's going to jump out and stab anyone right now. I think it's going to be maybe further down the line, unless there's some other shock that comes along. Of course, we've been subjected to a series of shocks from COVID and Russia and a lot of other things that have been going on the last few years that are hard to predict. But I think that right now we're in an okay place in terms of the economy, as long as the policymakers don't overreact to it. No, and I think we've got to be careful. I think a little bit about comparing fighting the last war and looking at the last recession as an example. That was very much more of a financially driven recession, meaning the banking system and the housing market, financial supports, really, were very weak and gave way under the weight of an aggressive Fed tightening that preceded that. And so I think in this case, the economy is much more resilient to the Fed right now, in part because of what happened during COVID and all of the fiscal support that happened. So in my mind, the next recession is more likely to be caused by some combination of the Fed, keeping rates too high for too long and fiscal policy becoming, too tight. And right now, at the moment, fiscal policy is actually still on balance relatively supportive. If you look at just something simple like the U.S. federal deficit to GDP ratio as kind of a rough proxy for how tight or loose fiscal policy is, kind of how much the Treasury is printing money effectively, that's still on the higher end of the range outside of wars and crises. It's kind of 5 to 6% of GDP right now. So that means that there is still fiscal support that's coming through to kind of add to the tailwinds that the economy has, whereas the Fed is kind of pushing the other way and acting as a headwind. So they're in some ways balancing each other out, and so you have strength in some areas and weakness in some areas, but it's not a recessionary situation. I think if you had a situation where the federal deficit contracted a lot and became much tighter, then you would have both policy levers pushing in the wrong direction, pushing in the tighter direction, and then you could have a recession, and then you could have unemployment rate go up to 5 or 6%, relatively easily, if both of those measures were going in the opposite, in the tightening direction. I think the extremity of the rise in unemployment in the last cycle was probably unusual in that it required both a catastrophic, kind of breakdown in the financial system and a relatively weak fiscal response afterwards. And so I think if we avoid those, issues, and we have a much stronger banking system now, then I don't think we'll have those similar problems during the next recession. So we might end up having less of an unemployment rate issue, particularly because we do have still a labor supply issue. There's just fewer people around to fill the jobs. And with immigration being still quite restricted, that may not change soon. So I think the labor side of things will probably hold up better than some of the other parts of the economy. My guess is that it's only going to be a contagion within the banks and firms that are directly exposed to the kind of venture capital, tech, crypto kind of side of the economy, and of course that's going to California is where a lot of that happens. So I don't expect this to be a broader systemic issue for the big banks that are really the core of the financial system. I think that they're not going to have the kind of exposure to the assets that are affecting Silicon Valley Bank that they did, say, to the housing market, which is vastly larger in terms of its scope and impact. I think that this is part of the ongoing kind of deflating of that whole tech, venture, crypto bubble that kind of really started in 2021 or late 2020, and that's been going on in various ways all along. And so I think it's been a kind of a stepping stone along the way that one thing tips over and then that knocks something else over. But I don't think those dominoes go all the way up to the major banks and institutions in the economy or the overall stock market. I think it's bad for those banks and their investors, but I don't think it's a systemic issue. And I think that from what I've read, the depositors in those banks are probably still going to be made whole. And that the system will manage to contain it. And it is tricky in real time to know how tight is too tight and so forth, and that's their problem as well. They have kind of made comments to the effect that they're more willing to make a mistake of over tightening than of under tightening at this point. And a lot of that has to do with their kind of public opinion and the credibility, and trying to kind of compensate for the fact that maybe they were a little late to start tightening in 2021, early 2022. When inflation was already rising, because they had 20 or 30 years of inflation that was almost too low, that they were willing to allow some inflation for a little while, and now it's maybe gotten a little ahead of them. So I think some of it is a public perception issue, but I think the way I look at it is, one, where are interest rates relative to what the kind of the market expects inflation to be over the next, say, 5 years, and you can get that price. There's inflation swaps and the Treasury inflation protection securities, the TIPS market can give you a pretty good estimate of what the market is pricing in for longer term inflation expectations. And that's been around kind of 2.5% for several months now. So most of the market and kind of people who are willing to put money on this are assuming that inflation will return to roughly where the Fed wants it to be in the next couple of years. And so if you think of that as kind of the baseline, then a 5% Fed funds rate, which is where we'll be shortly, is pretty high. That's quite well above the expected inflation rate. Now, if you compare it to the actual reported trailing 12-month inflation rate in the CPI, then it still looks like they've got work to do and they're not very high relative to that. But in my mind, and probably in the Fed's mind as well, that's very much a lagging indicator and probably not indicative of what inflation is going to be over the next, say, 6 to 12 months or longer. So I think the Fed is kind of pinched between the fact that the lagging data, things are changing rapidly, and the lagging data has not caught up to where they probably really are. And looking forward, the picture looks a bit different. And so on a forward-looking basis, I think the Fed is already fairly tight, and I think they kind of realize that. And if you look at their economic projections data, their dot plots and things they put out every quarter, those show that the long run expectations for where they think interest rates will settle down after things have all the ups and downs have been smoothed out, that kind of 2.5% is where they think the Fed funds rate will probably kind of normalize eventually. So if you're at 5% here shortly, you're well above where they think normal rates should be given the long run productivity and population growth. So that tells us that we're well on the high side of normal, and so maybe we get a little tighter, but going to 6 or 7% would be extreme, in my view. And that's, there are people talking about that. But I think as long as we avoid that, another quarter point or two is not going to make a big difference. But I think, the market is anticipating that rates will come down sometime starting next year, and that we'll get closer to that, 3 to 4% kind of range. It will be more typical.